हाय गाइस, होप यू आर डूइंग गुड। वेलकम बैक टू माय चैनल। तो बेसिकली गाइस, अभी ना मैं एक वीडियो बनाया हूँ पर्टिकुलरली एआई से, नोट ब्लॉक एलएलएम से। उसमें मैं कुछ रिपोर्ट्स पढ़ रहा था हॉस्पिटल सेक्टर से रिलेटेड, और उससे रिलेटेड ही मैंने उस वीडियो को बनाया है। मतलब साथ साथ मैं बहुत सारे रिपोर्ट्स को पढ़ रहा था, मर्ज करके बनाया है। उस एआई से रिलेटेड आप उस वीडियो को देख सकते हो कितना ज़रूरी है। और मैं कुछ अगर प्रेजेंटेशन होगा तो मैं लिंक डिस्क्रिप्शन पे ऐड कर दूंगा। देखो, अभी क्या हो रहा है, एवरेज रेवेन्यू पर बेड जो है, अभी दो टाइप का एक्सपेंशन होता है, ग्रीन फील्ड और ब्राउन फील्ड। वो मैं आपको कुछ वीडियोस में समझाऊंगा। बट अभी हॉस्पिटल सेक्टर में मैसिव बूम आ रहा है, और ये एक ऐसा सेक्टर है जिसमें हमेशा ग्रोथ रहेगा। इसमें कोई आपका मतलब रिसेशन का डर नहीं है, इसमें कोई वॉर का डर नहीं है। तो ग्रोथ बहुत है। तो आई मीन ये बहुत अच्छा सेक्टर है। तो आप इस वीडियो को देखो, उसके बाद अपन नेक्स्ट वीडियो में मैं और थोड़ा सा समझाऊंगा। बट इस वीडियो को देखो आप, एंड डू शेयर एंड लाइक मोर एंड मोर। सब्सक्राइब करो, ज़्यादा से ज़्यादा लोगों को शेयर करो, ताकि ये मोटिवेशन मिले और मैं अब और अच्छे अच्छे वीडियोज़ बना पाऊँ। थैंक यू।
Welcome to The Explainer. Today we're unpacking one of the most mind bending economic stories playing out in global markets right now. We are deconstructing the sheer compounding power of India's listed hospital sector. It's a fascinating story of massive expansion, shifting demographics, and a financial formula that essentially rewrote the rules of the healthcare industry. I want to hook you right off the bat with a financial paradox that absolutely defies typical business logic. Think about this for a second. What kind of industry manages to grow its profits by a massive 25% every single year, all while simultaneously executing a heavy, capital intensive build out of physical real estate? In most sectors, when you build aggressively, your profit margins get completely crushed under the weight of fixed costs and long ramp up times. But in this case, the exact opposite happened. The answer to that paradox is a staggering 25.3% compound annual growth rate in core operating profit between 2020 and 2025. And no, this isn't just some brief post pandemic spike. It's a sustained rewriting of an entire sector's profitability. To really understand the sheer scale of this boom, we've got to look under the hood. Section 1: The Unnoticed Healthcare Boom. Let's dive right in. To see how crazy this really is, just look at the supply data. Over a 5-year stretch, India's listed hospitals expanded their capacity by 37%, literally flooding the market with roughly 14,000 new beds. Now, pretty much any business student will tell you that a 37% capacity jump usually crushes margins. But here, profit margins actually expanded by an incredible 780 basis points. I mean, how is that mathematically possible? Section 2: The Margin Expansion Playbook. To figure out exactly how these hospitals achieved this impossible math, we need to learn a little magic industry acronym called ARPOB. That stands for Average Revenue Per Occupied Bed. It's essentially the heartbeat of hospital profitability, measuring exactly how much cash a single occupied bed generates every single day. Simply put, the higher the ARPOB, the healthier the business. Think of a hospital bed kind of like an airline seat or a hotel room. Profitability isn't just about adding more beds, it's about maximizing the daily yield of every single bed you already have. And the industry pulled this off through 3 very deliberate steps. First up, they shifted their focus to complex Congo procedures. That's cardiac, oncology, neurology, gastroenterology, and orthopedics. These are high-margin, highly complex surgeries. Second, they actively transitioned away from out-of-pocket cash patients toward fully insured patients who are way less price-sensitive when it comes to premium care. And third, they shortened the average length of stay. By discharging patients faster, they were able to cycle a lot more high-yielding surgical patients through that exact same bed over the course of a year. But they didn't just operate smarter, they expanded incredibly smartly too. We really need to contrast the different types of expansion here. Building a brand new hospital from the ground up is what's called a greenfield expansion. It takes massive capital and needs 12 to 18 months just to break even. A brownfield project, on the other hand, is more like a bolt-on upgrade. It leverages existing infrastructure and local brand recall, and the kicker? It breaks even in a lightning-fast 3 months. This breakdown brilliantly illustrates exactly why the last cycle was so wildly profitable. If you combine acquisitions, brownfield upgrades, and operations and management contracts, 70% of their new capacity came via these fast, highly capital-efficient routes. Only 30% was actually built from scratch. By doing this, they completely avoided that prolonged, nasty drag on their bottom lines. Section 3: 4 pillars of demand. So why are patients flocking to all these new beds? Well, there is a massive structural demand floor driving this whole boom, and it rests on 4 undeniable human realities. First, an aging demographic. 13% of India's population will be over 60 by 2030, and older patients naturally require a lot more hospitalization. Second, we're seeing a sharp rise in complex lifestyle illnesses or non-communicable diseases. Third, an expanding net of health insurance. And fourth, a massive surge in high-value medical tourism. When you look at how healthcare spending is evolving in India, it's really eye-opening. You can see a steady, structural decline in out-of-pocket health expenditures. But right alongside that, there's a corresponding surge in insurance coverage, tracking right toward 45 to 50% penetration by 2026. This is absolutely crucial because armed with insurance, patients don't delay treatments to save cash. They walk straight into premium private care. And then you add international appeal to the mix. Let's use India as the baseline cost of 1x for complex procedures. Getting that exact same care in Singapore costs over 3.5 times as much. In the US, try a staggering 28 times more. It's basically the ultimate medical discount, which is exactly why high-value medical tourism into India is compounding at a 20% annual growth rate. Section 4, the 23,000 bed cycle. Okay, so what happens next? Well, the industry is actually preparing for a build-out that makes the last 5 years look like a warm-up. Over the next 3 to 4 years, the sector has mapped out a pipeline of over 23,000 new beds. That is a truly massive volume of upcoming capacity, nearly 2.4 times larger than the entire last cycle. But here's the catch. The strategy is totally changing. Check out this shift in the upcoming build cycle mix. Greenfield projects, those brand new, built-from-scratch hospitals, now dominate the pipeline at 51%. Remember, in the last cycle, Greenfield was only 30%. Meanwhile, acquisitions have shrunk down to just 8% of the mix. So, the crucial point you need to take away here is this. Because a greenfield hospital takes 12 to 18 months longer to break even, and because there is a tightening supply of doctors and clinicians to actually staff these massive new facilities, the sector expects a temporary drag on profit margins over the next couple of years. For anyone actively tracking this market, you should expect to see margins feel the weight of this infrastructure ramp up before slingshotting back up by 2029 as those new beds finally mature. Section 5. Financial health and returns. Now, with all this aggressive building, you might be wondering, is the industry setting itself up for a massive debt crisis? To answer that, we just have to look at their capital expenditure. Back in FY20, the listed universe spent 19 billion rupees on capex. Fast forward to FY25, and that annual spend exploded to 80 billion rupees. That is a staggering 4-time surge. Normally, a 4x jump in infrastructure spending means taking on crippling levels of debt. But honestly, here is the ultimate proof of this sector's health. Leverage is actually decreasing. The net debt to EBITDA ratio, which is essentially how many years it takes to pay off debt using your operating profit, is falling below 1x across the majority of the universe. Some operators are practically swimming in net cash. As the data points out, the sector's Rs 225+ billion cumulative capex was funded overwhelmingly by internally generated cash flows. This is just an incredibly powerful realization. This hospital boom is a self-funding machine. It completely defies the typical debt-heavy nature of infrastructure cycles that we normally see in other industries. And all this self-funding translates directly into the ultimate metric of corporate success, return on capital employed, or ROCE. Across the board, returns expanded significantly. Major operators like Apollo saw their returns nearly double from 13.2% to 25.8%. Fortis climbed right out of single digits to hit 14.4%. Narayana jumped from 13.7% to an impressive 26.1%. This proves beyond a doubt that the capital deployed over the last 5 years was exceptionally efficient. Which leaves us with a pretty fascinating prospect. We have an industry structurally shielded by massive demographic demand, fueled by soaring insurance penetration, and possessing a balance sheet clean enough to self-fund its own aggressive expansion. So I'll leave you with this provocative thought. With all its structural tailwinds and proven financial discipline, is the Indian healthcare sector the most foolproof structural compounding story of the decade? It's for sure a market to watch closely. Thank you so much for joining me for this explainer, and keep learning.